Listen up, folks. The stock market is on edge, and for good reason. We've got geopolitical hotspots flaring up around the world, and that spells uncertainty for investors. From the Middle East to Eastern Europe, tensions are running high, and the potential for these conflicts to spill over into the global economy is very real. First, we've got the escalating conflict between Israel and Hezbollah. Israel has launched airstrikes targeting Hezbollah positions, and the possibility of a wider conflict is a major concern. Remember, folks, when war breaks out, markets tend to freak out. Then there's the ongoing war in Ukraine, where Russia's saber-rattling has reached a fever pitch. Putin's threats to use nuclear weapons are sending chills down the spines of investors worldwide. The specter of a nuclear conflict is not something to be taken lightly, and it's no surprise that markets are reacting with fear and uncertainty. Add to that the recent sell-offs in the Indian stock market, and you've got a recipe for volatility. Indian markets have been under pressure lately, and the combination of global tensions and domestic concerns has investors hitting the sell button. Bottom line, buckle up, because it's going to be a bumpy ride in the stock market next week. Keep your eyes glued to the headlines and be prepared for some wild swings. The situation in the Middle East is always tense, but the recent flare-up between Israel and Hezbollah has added a whole new level of anxiety. Israel's airstrikes, while presented as a response to specific threats, have the potential to ignite a much larger conflict. Hezbollah, backed by Iran, is a powerful force in the region, and they're not known for backing down from a fight. If they retaliate in a significant way, it could easily draw Israel deeper into the conflict. And let's not forget that the Middle East is a tinderbox. Any escalation between Israel and Hezbollah could quickly draw in other regional players, turning a localized conflict into a regional war. For investors, this means one thing: volatility. The Middle East is a major supplier of oil, and any disruption to the flow of oil could send energy prices soaring. That would be bad news for the global economy, and it would definitely send shockwaves through the stock market. We've seen this movie before, and it doesn't end well. Remember the oil shocks of the 1970s? Yeah, those weren't pretty. So, keep a close eye on the situation in the Middle East, because it has the potential to make or break the market in the coming weeks. Putin's nuclear threats are nothing short of terrifying. The man is clearly desperate, and he's willing to use any means necessary to achieve his goals in Ukraine. But here's the thing: nuclear war is not a viable option. It would be a catastrophe for everyone, including Russia. The global community has made it clear that any use of nuclear weapons would be met with swift and severe consequences. Even Putin's allies, like China, have warned him against crossing that line. So, while the threats are scary, I believe they're ultimately empty. Putin is a bully, but he's not stupid. He knows that starting a nuclear war would be suicidal. That being said, the mere threat of nuclear conflict is enough to rattle markets. Uncertainty is the enemy of investors, and Putin's reckless rhetoric has injected a huge dose of uncertainty into the global economy. We're already seeing the impact in the form of higher energy prices, supply chain disruptions, and a flight to safety in financial markets. The situation in Ukraine remains incredibly fluid, and Putin's next move is anyone's guess. But one thing is for sure: as long as this war continues, and as long as Putin continues to threaten the use of nuclear weapons, the stock market will remain on edge. Section 4. Indian markets. Feeling the heat. India's stock market has been on a tear in recent years, but the party seems to be winding down. The Sensex and Nifty, India's benchmark indices, have taken a beating lately, and there are a number of factors at play. First, there's the global backdrop. As we've discussed, the war in Ukraine, rising inflation, and the threat of a global recession are weighing on investor sentiment worldwide. India, despite its strong economic fundamentals, is not immune to these global headwinds. Second, there are domestic concerns that are specific to India. The Indian rupee has been weakening against the US dollar, which makes imports more expensive and fuels inflation. The Reserve Bank of India has been raising interest rates to combat inflation, but this could also slow economic growth. And then there's the upcoming meeting of the Securities and Exchange Board of India, or SEBI. The SEBI is India's equivalent of the SEC, and they're meeting next week to discuss a range of issues, including new regulations for the stock market. Any unexpected announcements from the SEBI could add to the volatility in Indian markets. Section 5. SEBI meeting adds to the uncertainty. The SEBI meeting next week is a wild card for Indian markets. The SEBI has been cracking down on shady accounting practices and insider trading in recent years, and there's speculation that they could announce new regulations aimed at increasing transparency and investor protection. On the one hand, this could be seen as a positive development. Increased regulation, while sometimes burdensome in the short term, can ultimately lead to a more stable and trustworthy market. This could attract more foreign investment and boost investor confidence in the long run. However, there's also the risk that the SEBI could go too far. If they impose overly strict regulations, it could stifle innovation and make it more difficult for companies to raise capital. This could hurt economic growth and send the wrong signal to foreign investors. The market hates uncertainty, and the SEBI meeting is a big question mark hanging over Indian stocks. Investors will be watching closely for any clues about the SEBI's intentions, and any unexpected announcements could send shockwaves through the market.